All right, so in this video, I want to talk about my investment strategy for 2019. I'm a little bit hesitant because I've had a bad year in 2018. So I'm hesitant between dividend investing, swing trading, and writing covered calls. So dividend investing, of course, reasons I like it, because it truly is the passive income way. Once you build it, all you have to do is receive the dividends. You don't have to do anything. You don't have to sell anything. You don't have to watch anything. Basically, you probably just have to withdraw the dividends from your trading account to your bank account. That's all you have to do. So it truly is passive. That's why I like it. I like the fact that to build it, to set it up, all you have to do is buy quality companies. You don't have to sell them. You buy and keep them forever. So it's much less time consuming, and you don't have to worry about the daily fluctuations of the stock market. So when the Dow Jones drops 800 points, it doesn't affect you. You don't care. If anything, you're happy because you get to buy more. You get to buy more of those dividend stocks that are on sale. So if for someone who truly wants to retire and make sure that they have a consistent revenue, consistent income stream that is truly passive, that they don't have to work for it to get it, dividend investing is the way to go, because you'll always be receiving 4 to 6% per year, if not more, on your capital. Regardless on the market value of your portfolio, you're always going to be getting at least 4 to 6% of your initial cost. But of course, if you buy a stock at $20, 25 years later, it's not going to be at $20. It's most likely going to be at $120, $150. So your capital, your principal, the money that you put in to invest with, is going to grow. You're never going to sell though, so you're going to keep it forever. You're just going to have a big capital, but your income, what you're going to spend, what you're going to live off, will be from the dividends, the portion of the profits that the company pay out to shareholders. So another reason I like dividend investing is it's very easy to pass over to someone. So if God forbid something happens to me, and I want to make sure that my family is financially secure. Well, if I've built a big mountain that's generating 4 to 6% dividends per year, all they have to do is collect the dividends and live off that. They don't have to track the stock market. They don't have to do any research. They don't have to know when to buy, when to sell. So it's much less of a headache, much less time consuming. You just sit back and collect the dividends. And it feels good knowing that you're part owner of a company, of a big company, a company that's selling products and services to people worldwide. But what I don't like about dividend investing is you never sell. So if you never sell, when do you take advantage of your capital appreciation? So for me, it bothers me to see capital appreciation and not take advantage of it, just have it sitting there, unrealized capital appreciation. It's true, anytime I could sell it and take advantage of it if I need to. So it gives me a security. I guess that capital appreciation would give me security knowing that it's there. But also at any time it could go away with market crashes. So any capital appreciation I built in 10 years can be wiped out in 1 year. And then I have to wait another 8 years or more to get back the initial capital appreciation. But over time, your capital will definitely grow. So that's the other thing I don't like about dividend investing, is that it takes time. It takes at least 25 years to build a decent revenue stream from dividends. Because you're growing at about 4% per year, the compounding effect of 4%, although compounding is great, but because it's only 4%, it takes time. It's not as great as if you're compounding 10% or 15%. So if you want to reduce the time frame, you have to contribute more to your investment accounts. But if you're not able to contribute more, you're going to have to wait at least 25 years to build something decent. To get over $1 million or $2 million, you're going to have to wait at least 25 years to get enough dividends generated from your capital. Because even if the capital grows, so you buy a stock at $20, in 25 years it's at $200, your yield pretty much remains the same, because it's going to be the yield on the market value of your investments, not on your cost. So if you spent $1,000 and the year where you spent that $1,000, the yield on that stock was 4%, yes, the dividends increase year after year, but the stock price is going to increase year after year. So the yield, which is the dollar received divided by the stock price, pretty much remains the same. Not only that, you've got inflation. You take into consideration 2% inflation every year, but you're gaining 4% a year. So you just reduced your gains by half. Yes, there might be capital appreciation, but you're not taking advantage of it. You're not compounding capital appreciation because you're not selling it. But the dividends you're receiving, you're using it to buy more stocks that pay dividends. So that's the compounding effect. And if you've had in mind, for example, that $50,000 per year was enough for you to retire on right now, in 25 years, it's going to be around $80,000 or $100,000 that you're going to need to retire on. So if you're making 4 or 5% dividends per year, instead of needing $1 million, you're going to need $2 million. So because of the time frame, everything changes. The plan changes, the goal changes. So I find that with dividend investing, although it is a sure way to grow your portfolio, a safe way, a very passive way, a very effortless way, but it does take time. You have to be patient. But the end result is, of course, great because you don't have to do anything. You just collect dividends. Even the process is great because all you do is buy stocks. You don't even sell. You just buy them on sale. That's all you do. So less of a headache, much less time consuming, less stressful. You don't have to worry about those bad days on the stock market. Dow Jones down 1,000 points. You don't care. So these are in my opinion, the advantages and disadvantages of dividend investing. But for me, the biggest advantage of dividend investing is the passive element in the dividends. Then you've got swing trading, which is buy low, sell high, buy low, sell high. So basically, that's mostly what I've been doing. It's just buying quality stocks. I do choose stocks that pay dividends because in case I buy the stock at the wrong price and it continues to drop, while I wait for the stock to recover, at least I'm getting something of it. But I do plan on selling because that's how I confirm profits, is by selling, making capital gains. So my strategy currently was to buy quality stocks that pay dividends, buy them low, sell them a little bit higher. Not necessarily at the highest point, but just sell them a little bit higher. Make 10, 15% per trade and then repeat the process. And then by repeating the process, that's where the compounding effect comes in. Now imagine you're able to do that. Let's say you have a portfolio of 100,000 and you use your full 100,000. I wouldn't recommend doing that, but just for example purposes, if you use your full 100,000 in one trade, it's not hard to make 5 or 10%. You could wait a little bit. If you buy the right stock, it's not hard to make 5 or 10%. Look at Amazon, for example. Bought it at 1,400. It's already at close to 1,700. So that's almost 15%. I've had so many trades where my capital gain is at least 10%. Now imagine if I did it with my full portfolio. And imagine I did that 3 times a year. So that's compounded, that's about 33% per year. Now, if you keep doing that for 25 years, compounding 33% on your portfolio is much greater than compounding 4%. But obviously it's much harder to execute because you have to buy at the right time, sell at the right time, and it's very hard to time the market. Most traders do not time the market well. In the long term, you end up losing. When I look through my portfolio, I have a lot of positive trades, and the fact that I tend to only put $1,000 or $2,000 per trade, so any positive trade I have has a small effect on my total portfolio. So I need to have several positive trades in order to impact my total portfolio. But if I were to separate my total portfolio in 4 chunks, for example, it wouldn't be hard to make 10% per year, at least, with swing trading. But it's just hard to put $25,000, for example, in one trade. Because sometimes you'll be wrong. Sometimes you did not buy at the right price. You have to wait a little bit longer till the stock recovers. For example, GE or Kraft Heinz. These are stocks that I bought a little bit too high. And I'm still holding on to them. But imagine if all my portfolio was in that, I'd have to wait over a year just for the stock to recover. But I've got many more positive trades. GM, GM, I think I bought twice in 2018 and was profitable with it. Ford as well. But then the last time I bought Ford, I'm still holding on to it and I'm losing on it. So you're not always going to buy at the lowest point and expect the stock to go back up right away. It might drop a little bit. It might stay at the same price for a while before it comes back up. So that's the issue with swing trading, which is just to buy low and sell a little bit higher. So that's what I like about it, and it's a little bit riskier. It's harder to be consistent, but I find that I'd rather do that in order to have a greater compounding effect, and I can reach my goal faster. I don't need 25 years. If I'm able to do 15% per year, I could probably reach the same goal in 10 years compared to dividend investing, which would take 25 years. So if executable, the time frame is much smaller. So that's why I like swing trading. What I don't like about it is that you're not an investor, you're more of a trader. You're an investor of your money, but you're not really investing in the companies. If you see your money, your own portfolio as your company, and you're just trying to grow your portfolio by any means necessary, then you're investing your money. But you're not really investing in the companies because you're ready to sell at any point. You're not there in the long run. You're not with the company through their ups and downs. You're just trying to take advantage of the price fluctuations of that stock. So I wouldn't call it investing. I'd call it more trading. So the other strategy that's on my mind and I just don't know which one to take is writing covered calls. So if you watched my previous videos, I have pretty much a lot of videos on covered calls. So in November and December, I've sold some covered calls and made $1,200, and I was still able to keep the shares. So on stock that I hold that I didn't sell yet, I'm able to sell covered calls, or basically sell call options on these stocks. And basically it's just premiums that I'm collecting for free, and I keep my shares. But they come with a risk, is that your shares can get called away at the strike price that you chose. But if the stock price does not go above the strike price at expiration, you get to keep the shares. And that's what happened in November and December. But tomorrow, January 18, I've got options that are going to expire, and most of them are trading above the strike price. So that means my shares will get called away unless I buy back the call option. And if I buy back the call option, then it defies the purpose of selling call options to collect extra income from shares that you're holding. So I like covered calls because it allows you to make between 1% and 4% per month on shares that you already hold, but it's not that consistent either. Some months will be good, some months will be bad. So that mystery, that inconsistency bothers me, not knowing if every month will be the same, and not knowing how many good months you'll have versus how many bad months you'll have. At the end of the year, will you be on top, or will you be spending money buying back call options just because you want to keep the shares? Now, obviously, the fees involved with writing covered calls is a lot. Pretty much eats up most of my profits. I would have to buy 100 shares of Facebook or Microsoft so that the fees represent a smaller amount on the commissions received. For example, I bought American Airlines at $31. I bought 100 shares at $31, and then I sold the call option at a strike price of 31. So it's called a at the money strike price, at the money call option, and I collected $165. But now American Airlines is trading at $33. So if I didn't sell the call option, I would have been better off. I would have made $2 instead of just $165. But now I can't do anything. I have to wait until expiry date, unless I buy back the call option and sell it. Unless I buy back the call option and then sell the shares on the market. But as you can see, I'm just wasting money on fees, and it's just too much of a headache. Imagine if I'm doing that on a $1 million portfolio. It'll be too many stocks to manage, too many transactions to manage as well. But let's say I accept that my shares get called away at expiry date. I think they expire February 1st. So I will have collected $165 on a $3,100 investment, which I believe is about 4%. But from the $165, I have to remove $5 for buying the stock initially. I have to remove $11 for selling the call option. $25, I have to remove $25 for getting my shares called away automatically. So that's a lot compared to $165. So either you buy more shares or you buy shares that are more expensive so that the call option received is about, let's say, $500. So if you remove $5, $25, and $11, it's not that much. Doesn't represent a big percentage like in the other example. So these are the three strategies that I'm hesitating between: dividend investing, swing trading, and writing covered calls. They all have their benefits. They all have their disadvantages. So yeah, I just wanted to share that with you. I will gladly read your comments and your opinions. I know most subscribers, most of the comments I get, actually dividend investing came to me from subscribers. I was always into swing trading, but I get a lot of subscribers that leave in the comments or send me emails about dividend investing, how buying and holding long term is the best way to go. See, and the other reason why I can't really do dividend investing is that I borrowed some money from American Express at 3% interest rate per year. So I'm not going to borrow money, spend 3% interest just to receive 4% dividends per year. And I'm not sure that the stock I buy is going to appreciate in 1 year. I also borrowed a little bit from my line of credit at 5%. So if I'm going to pay interest 3 or 5%, it is to make at least 10% profit per year. So that's another reason why I'm hesitant about dividend investing, but I do like the passive element of dividend investing. So yeah, please leave your opinions in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get between $25 and $250 back. Also check out the referral links in the description to help support the channel. Thanks for watching.